we have our debtors to be this, 80,000. That's our debtors. Since we have debtors, it is possible that not all the debtors will pay back. And because not all the debtors will pay back, we need to make a provision for bad debt under accounting concept of prudence, so that we won't overstate our profit or understate our losses. So we need to make provision for bad debt. So making provision for bad debt means in case the debt goes bad, we have a place to take certain amount of money from. That is why we have provision for bad debt. Yeah. Do you get what I'm saying there? So now the situation comes up. With these 80,000 debtors, we have a provision for bad debts of 3,000. So originally, going forward for the accounting here, we have debtors of 80,000 and we made the provision for bad debt of 3,000 done. But in the course of the year, we figure out that Montoya will not be able to pay back. Because Montoya is not going to be able to pay back based on the fact that it has been declared bankrupt. The 4,000 Montoya is owing us has to be taken away from the debtors. The 4,000 Montoya is owing us has to be taken away from the debtors, because Montoya is not going to pay. So we are creating a new bad debt because certain credit customer is not going to be able to pay back. So because we are creating a new bad debt, we debit the bad debt account and we credit the customer's account because the customer is not paying. We assume that the customer is paying because we are going to pay for the customer now. Are you getting what I'm saying or not? You credit the giver, you debit the receiver. Montoya is supposed to pay us, yes or no? But Montoya is not going to pay anymore because Montoya has been declared bankrupt. So that created a new bad debt account. So creating a new bad debt account means we debit bad debt account, we credit the customer account. That is this transaction for the first journal entry. So bad debt has been created for 4,000, which Montoya is not going to be able to pay.
We credit Montoya.
Yeah, we credit Montoya. We debit bad debt account because we are creating a bad debt account. Because we are creating a bad debt account, we debit bad debt account. If our bad debt is also increasing, we debit it. Increase of bad debt will be debited. Creation of bad debt will be credited. Do you understand the two credits here now? The two debits here. So, because Montoya has been declared bankrupt, he's not going to be able to pay back. Bad debt has been written off. Bad debt account has been created for 4,000. Debtor, who is the debtor? The debtor that has been declared bankrupt is not going to be able to pay back. Montoya, you credit it. So that means our bad debt has been written off. So Montoya is off the account because Montoya is not going to be able to pay. Why? Because it has been declared bankrupt. When you are being declared bankrupt, it means you don't have capability to pay back. So the debt has gone back. Debt goes back. The debt goes back. The debt goes back. So it's on the business now. The business has to bear the consequence. So that's why we are creating that's why we created a bad debt. We made a provision for bad debt, but we have never created a bad debt. Now that a customer is not going to be able to pay back, then we have to create a bad debt. There's a bad debt already. And the bad debt is as a result of Montoya not being able to pay back. So the journal entry for a bad debt creation is you debit bad debt account and you credit the customer's account. Who is the customer now? Montoya. Do we understand the journal now?
Yes.
Bad debts, because the debt has gone bad. Bad debt account has been created for 4,000. But this is the debit side. What about the credit side? The credit side has to be for who? Montoya. Montoya was supposed to pay us, but it's not going to be able to pay us. Bad debts. Who is not going to be able to pay us? Montoya. Please, can you just lift it instead of dragging? You lift. Do you get it or not? So, bad debts account 4,000. That is not going to be able to be paid. It becomes an expense. That is why it's in the debit side. Who is not paying us? Montoya. Who is the debtor? We credit it. Done. Now, the ledger account for this transaction, look at it here. The journal entry here would have a ledger account. And the ledger for this transaction will be bad debt and Montoya. In the journal, bad debt is debited. In the ledger, bad debt will be credited. Are you with me or not? This is bad debt account, right? And this is Montoya. That's the first transaction in the journal. For every journal, there will be a ledger. The journal will be transferred to what? To the ledger account. So for this transaction, we're going to have Montoya's account. Okay. Montoya is going off, right? So because we have created a journal for Montoya, we have to create a ledger for Montoya.
So
this is Montoya's account, right? She's not going to be able to pay back. It's an expenses for us, we debit it in the journal.
yes.
Montoya credited in the journal, right? Now Montoya's account. We have Montoya and we have the balance brought down, which is how much? 4,000 that Montoya is not going to be able to pay. Montoya is not paying us anymore. The business has to pay. So in Montoya's account, we're going to have the balance brought down, the amount of money that Montoya is not going to be able to pay, and the bad debt account. Because for this journal, there will be a corresponding ledger for it. So Montoya is the account. Montoya is the owner of the account, yes or no? But Montoya is not going to be able to pay. At it being Montoya paid, we'll credit Montoya. We won't even have bad debt. We only have purchases and Montoya. But Montoya is not paying. That is why we are having this. Do you get it or not? Okay. So, for Montoya's account, we open Montoya's account. The debit side of Montoya's account will be the balance that Montoya is not going to be able to pay. 4,000.
And the credit side.
And the credit side will be the bad debt. Remember the bad debt here is on the debit side in the journal. So it will be on the credit side in our ledger. Get it right, please. Your journal entry, we have bad debt as credit, Montoya as debit. Now we are opening Montoya's account. In the course of opening Montoya's account, bad debt will be what? On the debit side. Bad debt will be on the credit side, Montoya will be on the debit side there. The balance Montoya is not going to be able to pay. Does it make sense or not?
Yes.
This is Montoya's account. Montoya is going off.
Yes.
Because we have written it off. But before we close it down, this is closing it down, we close it already. Because we have created a bad debt account. For how much? 4,000. The amount Montoya is owing us, which has been transferred from the account to Montoya to bad debt account. So in Montoya's account, this is a new transaction. The bad debts has been created. The debit side here becomes the credit side here. How much is Montoya owing the business? 4,000. It's off. The account is done. Montoya. Because we are going to pay. Do you get the first transaction here?
Yes.
The balance brought down is telling us that the account for Montoya is closed. Because Montoya's account has been written off as a bad debt. So bad debt account 4,000, Montoya's account 4,000. Done. Because we've opened Montoya's account, we are creating a bad debt. On the credit side here, on the credit side is the bad debt account that has been created, and on the debit side is the balance brought down for the year ended 2024. We are done with Montoya. Now, the bad debt account will be created. This is Montoya's account. We're done. So from Montoya's account, we have gotten the bad debts. Bad debt account will be what? Created. But before we create bad debt account in the ledger, we have to create a journal. The transaction is a step-by-step thing. The first thing that happened was a bad debt was written off. And because a bad debt was written off, it means we have increased our expenses. We have to create a journal entry, which we did. Bad debt account has been created, we debit it. Montoya's account will be credited. We transfer it to the ledger for Montoya. Bad debt will be credited and the balance brought down. Done. Now, this transaction, this account will be transferred to the profit or loss account. It is written down, it will be transferred to the profit or loss account. So this transaction, the bad debt account will be opened. Montoya is off the radar. We don't have Montoya anymore. We only have expenses instead of Montoya. Get it again. Montoya is gone. So instead of Montoya, we have what? Expenses. And where would we record expenses? We record expenses in profit and loss account.
So we take the debt from Montoya and we spread it 4% of outstanding debt.
No, forget about the 4%. Don't even talk. Don't get there yet.
Ah.
I'm talking about Montoya that is owing 4,000 that is not going to be able to pay back. That is what we're talking about. Don't mix it up. This is the transaction. The debtor for this business is 80,000. The provision for bad debt is 3,000. We make provision for bad debt because some of your debtors will not be able to pay back. That is why you make a provision for bad debt. But in the course of the year, we figure out that there is a bad debt written off because Montoya, who is a debtor, has been declared bankrupt. Because he has been declared bankrupt, he's not going to be able to pay back. That becomes an expenses for the business. So that is a bad debt that has been created. And when you create a bad debt, you debit bad debt accounts because it's an expense. So the journal entry for this situation is bad debt account to be debited for 4,000, which is not going to be able to be paid back. And who is not paying it back? Montoya. Credit it, done. Now, the next journal entry, because we have to transfer all the bad debt written off to the profit or loss account. Because this situation means the business is paying instead of Montoya, yes or no?
Yeah.
Okay? If the business is paying instead of Montoya, it becomes an expenses for the business.
Profit or loss.
Where do you record expenses? You record expenses in the profit or loss account. That is why when we are transferring bad debt, we don't transfer debtors anymore. We transfer PL. Because this is an expenses now. So bad debt being written off, done. We take the bad debts because we have created the bad debt account. With what? A profit and loss account because it's an expenses for the business. There's no more Montoya. So Montoya's account for this journal entry is the ledger. So for every journal there's a ledger. For this ledger, this is Montoya's account. Bad debt will be paid. It becomes a bad debt, right? The business is paying. So the bad debt account will pay instead of Montoya. Yes or no? You credit the giver. You credit the giver. The bad debt account is paying instead of Montoya. How much is the bad debt paying? 4,000. Balance brought down. Account of the Montoya is over. The journal ended it here. The ledger also ended it.
Yes.
Do we understand the first situation now? Now, the bad debt has been written off. The next thing is bad debt account and expenses, which is profit and loss account. Your debit and credit transactions. If it is an expenses, you debit. If it is an income, you credit. That is the law. Expenses, you debit. Income, you credit. In your profit or loss account. So at this situation, is it an income or expenses?
Expenses.
Is it an income or expenses?
Expenses.
It's an expenses because the business is paying. It's an income if the business is getting. So, profit and loss account, because on expenses, 4,000. For what? Bad debt account, 4,000. So, we're going to open a bad debt ledger. If you are opening a bad debt ledger, here you have the profit and loss account will have a credit entry. The bad debt will have what? A debit entry. So now look at the bad debt accounts. For bad debt account, profit and loss accounts, which is a debit here, becomes what?
Credit.
Are you guys getting it or not?
Yes.
No.
And the bad debts become debt.
For Montoya, because the bad debt is for Montoya. So Montoya is having the money now. Montoya, we assume that the expenses is done. So this is the expenses of Montoya. So we say that Montoya account is done, then the bad debt account will be created. Expenses means spending. Look at it this way. You sold to a certain customer, but the customer is not going to be able to pay back. You sold to a customer, but the customer is not going to pay back. Because the customer is not going to pay back, you have to pay back. Because the business is separated from you. Business entity. The business should be treated separately from the owner of the business. So that is why when you put money into the business, it is called capital. When you take money from the business, we call it drawings.
So the business uses capital to close off any bad debts.
No, I'm just explaining something. I'm explaining the principle of entity. Why the business should be treated separately from the owner of the business. If the business and the owner are the same, then we don't have capital and drawings. But in accounting concept, the business should be separated from the owners of the business. Are you getting it, please?
Yes.
So, because the customer is not paying back, you have to pay back into the business. And because you are paying, it is an expenses on you, on the business. That is expenses. So Montoya's account becomes a profit and loss account, expenses. And for expenses, it's a debit entry. So here, Montoya's account will have the bad debt on the credit side because the bad debt is paying Montoya now. And for the bad debt account, we have our PL, which is an expenses. The PL will be paying the bad debts. Bad debt is paying Montoya. PL is paying the bad debts.
Who pays PO?
PL, no, we pay PL because it's a provision we make.
Ah.
So the provision we make is already there. It's a provision. PL will be paying bad debts. Bad debt will be paying Montoya. So both are credit entry. So when you open Montoya's account, it's going to have a bad debt as a credit entry. When you open bad debt account, you're going to have PL as a credit entry. Profit and loss account is 4,000. The amount of expenses that will be paid. The bad debt account, because these are the two accounts that we need now. Bad debt and P&L accounts. Now, it has been transferred to the profit and loss account because it's an expenses. So because an expenses has been transferred, so 4,000 has been transferred. Now, the next question is, they said 4% of outstanding debtors. 4% of outstanding debtors is 4 over 100 multiplied by 80,000. That's how much? 3,600, right? No, 3,200, right? 4 times 800.
4 times 800.
3,200. 3,200. You take it away from this. So that becomes what we have as our. What do we have here? No, we can't take it from 40,000 because we have Montoya that is off. Montoya is off already, right? This amount is off. It's not part of our debtors anymore. Montoya is not going to be able to pay. So our debtors has reduced from Montoya's expenses. Do you get it? Montoya is not going to be able to pay. Montoya is part of the debtors, but it's not going to be able to pay. Yes.
80,000 or 80,000 minus 4,000.
Yeah, so 80,000 minus the 4,000 that Montoya is not going to be able to pay.
76,000.
76,000.
Debtors.
That's the new debtor.
What do you mean when you say debtors?
Debtors are your credit customers.
People who buy on credit?
Customer that buys on credit. But if you buy on credit from your supplier, you're also a debtor. So 4,000 is gone because Montoya is not paying. So we have 76,000 euros as our debtors now. As a result of that, the business is increasing its outstanding debtors by 4%. So it means 4% of 76,000. Do you get it?
Yes.
So 4% of 76,000 is what? We did it yesterday, right? 4 over 100 multiplied by 76,000. 0, 7 times 6, 24, 4, made that 2. 7 times 3, 28, and then 30. 3,040. That is the new provision for bad debt. Do we get it or not? Debtors, when we have a debtor, we make provision for bad debt. But our debtors here now has been reduced and we have increased the percentage of debtors. So that means we have a new provision for bad debts. So this means we need a new journal entry. Because this is the new provision, right? This is the new provision for bad debts. The old one was what? 3,000. For debtors, 3,000. Now, for 76,000, it has increased by 4%. So the new provision for bad debt is 3,040. So 3,040 minus 3,000 is 40.
40. Provision new.
So our provision for bad debts now is what? 40. And the profit and loss account will have what? 40. Because you have created a provision for bad debts. And for you creating a bad debt provision, it has to be debited in your profit and loss account because it's an expenses. Do we get it? So here, our debtors has reduced from 80,000 to 76,000, and said we should increase our outstanding debtors by 4%. 4% of 76,000 is 3,040. You have to take it away from this because this is the old provision and this is the new provision. The difference between this and this is 40. That means our bad debt has what? Increased. If it reduces, you credit. Because when it reduces, it's an income. But here it increases, right? From 3,000 to 3,040. That increases. Because it increases, it's an what? It's an expenses. Income, you credit. Expenses, you debit. Do we get it?
Yes.
Okay. So, the bill transfer to PL, provision for bad debt is now 40, and the P&L account will have 40.
What does it mean provision for the bad debt mean?
Provision. Provision means you are making availability for debt that will not be paid. In case the debt goes bad. Provision means you are making availability, you are making arrangements in case somebody does not pay back. That is provision. You are making it available. Oh, in case this happens, I have made provision for it. Oh, you're going out. Have you made provision for transportation? Do you understand?
Yes.
So, the next journal is provision for bad debt 40 and P&L account 40. Then we have a ledger for it. Provision for bad debt account. Our balance brought down is how much? 3,000. That's the previous provision for bad debt, and it has increased by what? 40. So the new provision for bad debt is what? 3,040. Do we get it or not?
Yes.
This was our provision before now. It has increased by 40. So 40 plus 3,000 is 3,040. So our balance now is 3,040 for the provision for bad debt. So provision for bad debt account, we're going to have both on the credit side. The balance brought down from the last year, or from the previous one, the old provision for bad debt 3,000, and the new one which has increased by 40, making 3,040. 3,040. The new provision. And that's it. The balance brought down. Both of them are expenses for the business. So the ledger here, or the journal here, this is the ledger for provision for bad debts.
Doesn't this mean 860?
What?
860 is is left because the provision is 3,040 and the debt is 4,000.
Bad debt is 4,000. We're done with the bad debt. The bad debt is done because we are taking it away from the debtors.
Yeah.
That's why we created these two accounts. We're done. So what is left is we taking this into the profit and loss account as a bad debt written off. Expenses. That is in the profit and loss account. So we have two expenses here. We have this as an expenses and we have this as an expenses. 4,000, which is bad debt written off, is an expenses for the business. 40, which is the new provision for bad debt, is also an expenses. So these two will go to the profit and loss account. And in our balance sheet, we're going to have the new debtor, instead of 80,000, we're going to have 76,000. Where is it? Those are the transactions. So now we're done. So we have to extract our profit and loss account. So the profit and loss account, we have bad debt written off, which is 4,000 of that of Montoya as an expenses.
Expense.
An increase in provision for bad debts,
Is expense.
40. If our provision for bad debt reduces,
It's
it becomes
income.
decrease in provision for bad debt. It's not going to be here, it's going to be on the other side. Because it's an income. If your provision for bad debt reduces, it's an income.
If increases.
It's an expenses. So the two expenses here now are 4,040. Now we have our balance sheet. In the balance sheet extract, we have debtors and less provision for bad debts. The new debtor is how much? The new debtor is 76,000. And how much do you make for provision for bad debts? 3,040. The old debtor, 8,000. In the balance sheet, it will be 8,000 minus 3,000. But now we have a new provision for bad debt, and we have a new value for debtor. So in the balance sheet, we're going to have debtors, 76,000, minus provision for bad debts, which is 3,000, the new provision for bad debts, and the new debtor.
But is there any way I can get paid back, or is it just I just pay?
Sometimes we call it irrecoverable debt recovered. Irrecoverable debt recovered. If this happens, if Montoya finally pays, everything that we've done here will be opposite.
So it becomes 80,000 again.
If he pays,
Yes.
yes, it becomes 80,000, yes.
Yes.
But it becomes 80,000. Here we're going to have bad debt recovered on the credit side. And we're going to have Montoya on the debit side. We're going to have profit and loss on the credit side. We're going to have bad debt irrecovered on the credit side. So everything we've done here becomes opposite. If Montoya finally pays. But because Montoya has been declared bankrupt, there's no likelihood that Montoya will pay back. Is provision for bad debt clear now?
Yes.
We make provision for bad debt because we have a customer. We have sold on credit to customers. Some of them will not be able to pay back. And whatever we make as provision for bad debt, we take it away from our debtors. For every debtors, there should be a provision for bad debts. For every debtors, there's a provision for bad debts. The only time you don't have provision for bad debt is when you don't have debtors. But there's no way businesses will sell without selling on credit. You will still sell to some customers on credit. Either because your competitors are selling on credit or you want to increase your customer base. To attract more customers, maybe you have to sell on credit.
When you say selling on credit, does that mean buying something without paying?
Yes. Do you get it?
Yes.
Now you can write. So you write, we did this yesterday. You are not here, you were not in class yesterday. I don't know where you went to, both of you. Okay. So you write this, the ledger, the profit and loss, and the balance sheet.